everyone. Good morning and welcome. I'm Shruti Gandhi, founder of Array Ventures. I just want to remind you that please text any questions you have to the number we have up there on the board. And then I'd like to hand over the stage to Michael Torosian, the partner from DLA Piper. And we're going to have an amazing conversation on exits.
Hi, everyone. Thanks for being here today. We're very excited to be having the panel here on exits. Okay, great, thank you. Just to give a quick introduction to myself, I'm Mike Torosian. I'm a corporate partner at DLA Piper. DLA Piper is one of the original Silicon Valley law firms working with emerging technology and life science companies, and we're now the largest law firm in the world. We've got 4,200 attorneys and over 70 offices in over 30 countries. And we're consistently in the top 2 or 3 of venture capital, mergers and acquisitions, private equity, and also one of the top firms doing IPOs and public offerings. So we work a lot with companies at the very earliest stages, and then we grow with those companies as they grow, taking their next steps through funding and developing the company and getting to the point where they're thinking about a potential exit, whether that's through a sale of the company or a public offering, and then life as a public company potentially after that. I act as outside general counsel for companies at all stages, from formation to seed to venture rounds, and then again a potentially sale of the company, and then a potential IPO or later even life as a public company. So that's just a quick background on myself. I'm going to moderate the panel here. We have a great panel here, a really good diversified group here with some great expertise, and I'd like to open it up to them to do a quick introduction of themselves and some background, and then I'll kick it off with some questions that I hope will be helpful to folks here in the audience. And we've also, as you guys know, have the iPad here, so if you guys are sending questions, I'm happy to add those as well. So just to kick it off.
Thank you, Michael. Ashmeet, Sidana, I'm a venture capitalist. I've been practicing as a venture capitalist for about 10 years. But at heart, I'm really an engineer, and I run a firm called Engineering Capital, focused on engineers who are solving interesting technical problems at the seed stage. So if you're solving an interesting problem, I'll write you your first check.
Jishnu Bhattacharjee, I'm a partner at Nexus Venture Partners. We are a venture capital firm focused on investing in US and India. We have about $1.2 billion under management. And our preference is to be the first institutional investor in a company, and we follow the company through the life cycle to exits, which is the topic of the panel. Along with sharing my views in general on exits, I would also be happy to talk about exits of cross-border companies as it relates to India, to the extent that there is interest in the audience to hear about it. Thanks.
Good morning, I'm Leigh Wasson with BNY Mellon Wealth Management, and I am a wealth manager for entrepreneurs and founders. And following up on Ashmeet's comment, at heart, I'm an advocate for founders. And look, many of you have taken risk, you've executed well, you've innovated, and it's time to put the right team around you, just as you will around the exit that we'll talk about, around your personal financial planning. And I'll tell some stories and share some insights on that topic.
Great, thanks guys. So maybe we can start at the beginning. So I'm a founder. When should I think about the exit? I just started, came up with my idea and I just started my company.
Well, the classical answer for that is that you should never be thinking about an exit if you want to start a company. You build a company, you run it forever. Warren Buffett says he likes to invest forever. He has no time horizon. But the realistic thing is, we do think about exits. We are motivated about what we're going to get at the end of the road. Many of us are interested in money. Most of us are interested in money. And certainly that's often what the exit creates. So it's never too early to start thinking about an exit, but the way I would characterize the Warren Buffett comment is, don't make that your exclusive focus. If you only think about that, that's too narrow a focus, but it's never too early.
I'll just add that a very wise person told me the best time to plant a tree is 20 years ago. So I think if the best time to think about an exit from what it might bring to you from a personal financial perspective is now. And by that I mean get the information and the knowledge that you need, again, to make the smart decisions early, because being early in your planning can mean a great deal from a asset protection, identity protection, tax minimization strategy. And there are a lot of people in the business here who want to invest in you before you invest in them. So surround yourself with advisors who can assist you, whether you're a year out or 6 months out.
Maybe just only thing I would add that the best exits are those where companies are bought, not sold, or companies goes public. Yes, it's a classical statement that you should never think of exits. I think there is value to it, even if you want to really have the right outcome when you sell the company. And I will elaborate it more when we discuss.
Let me add one other comment to that, just in terms of the practical matter in the venture ecosystem, what we see over here. So I've had over half a dozen companies get sold through M&As. Some were great, everybody made lots of money, some were not so nice, just practicing as a venture capitalist. An interesting question to answer might be, how long before the actual deal happened did the conversation start with the actual acquirer? In other words, there were other conversations that happened that obviously did not lead to fruition. And that average for me is over a year. And most entrepreneurs underestimate that time.
Great, thank you. One follow-up question on that. So, okay, I'm a founder and I should be thinking about the exit, early on. What about when I'm just trying to get funding? So should I have that in the, investor deck, in the pitch, being able to show the understanding that, hey, there is an exit potential here. What is that exit potential? Is that when you guys are talking with investors, should they have that not only in the back of their mind, but also as part of the presentation when they're really talking with investors? Hey, I know that we could maybe go public eventually, but here is also the other, the potential exit. Not that we're trying to do it right away, or maybe we are, but at least putting down on paper or in the presentation, we're thinking about the exit.
There's a wide variety of opinions on what is the right answer over here. And so there is no right or wrong answer specifically, but I can give you some general trends. Firstly, in terms of sectors, purely in the venture sector, it's unusual to focus a lot on the exit potential with specifics in early stage investing. Later stages, perhaps people are a little bit more explicit about it. However, what is important, and something which you can do in even very early stage investing from an exit perspective, is talk about the market and think about how will this be a highly valued company? Does it have the kind of characteristics that if there was an exit, it would have a high multiple, a high valuation, there would be a large number of potential acquirers, or an attractive IPO market? Those are things that you can start very early to talk about.
Yeah, to add some VC perspective here, as a firm who invest in companies for the long term, and after we invest, we also support the company through the life cycle. I would say that at least from our angle, we never expect the entrepreneurs to specifically talk about how he or she would exit the company. We definitely think through it internally, but we feel that that should come out spontaneously as you talk about your concept, your idea, how you're building it. And of course, there are different opportunities of exits, and we think about it, but we don't really expect entrepreneurs to even talk about it. We are just fine if he doesn't mention exit at all in the pitch.
Thanks, guys. And just a bit of a follow-up on the investors that we have on the panel here. At what point do you invest? Kind of how much do you invest? What types of companies are you interested in? Just to give folks a sense of kind of where you guys operate.
I've invested across a wide variety of sectors and stages in my career, so I have experience across them, and I'm happy to answer questions in that context. But right now, my firm, I'm only doing seed stage investing. I will anchor and lead a seed investment, typically in the $500,000 or $1 million range, right when a company is getting started, before there are products, before there are customers, very, very early.
We want to be the first institutional investor in a company. What that means is that mostly we are doing Series A's to start with, but we have also done quite a few of seed investments. I think our check sizes have ranged from 100K to 10 million. And then whenever we are investing, we have sufficient reserves for the company through the life cycle. For select companies, we have even invested up to 45, 50 million.
Great, thanks, guys. And as founders are developing and building the company, how should they think about sort of the process of getting to that exit down the road? And is it this is a company that they need to look at? Is this really a company that's built to be sold, or potentially is big enough to go public in an IPO? What is the sort of the thought process kind of going into that, and how does that develop and evolve over time?
I don't believe you can build a company to be sold. I think that's a fool's errand, and it's really not something which I would encourage anyone to do. In other words, you should really start thinking about selling in only two scenarios. One, you are doing so well that you are approached by someone without any planning on your behalf, which is the classic case of you being bought, not sold. Someone walks in, makes an offer, of course you should think about it. That is how the great exits often happen. The other scenario is when, for whatever reason, after whatever amount of time, you've decided that you do need to sell and you are not going to be able to get to a great place. That's a much tougher road to hoe. It does happen very often, of course, since many startups don't succeed. And so let me talk a little bit about that process and how it works itself out. So clearly in this case, we've established ourselves that we are not going to go for the moon. It's not going to be this amazing thing. And the first answer that you will often hear from people at that point is, oh, let's just hire a banker and we'll get sold. Well, I hate to say it. I love bankers. I work with them. I understand the value that they add. But that is not how companies get sold, even in those scenarios. In fact, my default advice to entrepreneurs is that a banker is helpful to you only after you have your first term sheet. In other words, you have to go and do the work to get that partner, to get the acquirer who will help you bring that in. So how do you do that? You do it in the following way. Perhaps you approach them for strategic investment. Perhaps you have a business relationship with someone. That is how the conversation often starts. And that is why I said right at the beginning of this panel that life cycle for all the way to a successful acquisition is a very long life cycle. In my experience, it's been over a year in most cases where that conversation occurred. And then, of course, even the date of acquisition is not the end of the story. You are now going to become part of a larger entity. The buyer has expectations from the team, from the product, from the market, and all of those have to be satisfied. So that's really the life cycle of the exit.
Very nicely articulated, Ashmeet. Only thing I will add here is that after you get your first offer, then sometimes it's valuable to run a process. And that way, it might also end up that even after running the process, actually the company who has given you the first letter of intent actually ends up buying you. It's just that, for a price, the price might be 2x or 3x higher. So that's how it would work. But there has to be a very, very strong, either business or commercial relationships or strategic interest, and it would be important to be cognizant of that when you are building it out, in a sense that, how do you become an integral part of the ecosystem? How do you look at expanding partnership opportunities and just like, building the business out so that the implicit synergies are built, not sought for.
And as Ashmeet and Jishnu were commenting, obviously this becomes a very rigorous, time-intensive process. You're working 24/7 on the deal, which is, again, why it is very important to have taken the time before the deal is presented to have the advisory team around you. And by that, I mean a high-quality wealth management firm, a high-quality CPA, high-quality trust and estate attorney. And your deal team can help you meet these people, right? This is a very collaborative community that we're in, this ecosystem for entrepreneurs. And there are a lot of people who can assist you and help you take an inventory of what you own in founder stock, understand the current public market portfolio you have. Many of you are very young. You have the benefit of compound interest in investing early. You need to maximize all that while you're going through this process, and then understand when there is a deal at the table, the type of smart planning you can do, either because you have charitable intent, because you want to minimize taxes, because post-deal you can create an income stream that defers taxes, gives you a tax write-off, and brings income to you over a very long lifetime, and then leaves the assets to charity. And we have one founder that we work with who they set up a charitable remainder trust, prior to the deal closing. And with all the other assets they received, they reinvested in angel companies because that's what they know. And all those assets went to zero, and they have this lifetime income from the charitable remainder trust. So you really need to take money off the table. You need to balance your risk and return. There are many, many examples of where smart planning is a way to really just keep you able to continue to invest in the next startup.
You know, an exit is a very intense period, probably the most intense period that you will experience in the formation of your startup. And so, Leigh's talked very eloquently about one aspect of what you may be considering, in this case, wealth management, money, financial planning, etc., which is a personal event that will occur for founders, but also the entire team in the company. There are many aspects of this kind of intensity occurring. So to make it tangible for you, let me give you a little story of a company that I sold, where I was an investor, early stage, acquired by a nice Silicon Valley, Fortune 500 company over here. And the founder, I was asked about that company just yesterday on a different panel, that how often do you have board meetings? And the story I shared with the audience was, in that case, we were doing board meetings every 3 hours for many days. Because now, admittedly, this was a large outcome. There were many hundreds of millions of dollars at stake. But that is how intense it gets. That's just the board meeting. That's just the formal discussion of where a particular decision may occur. There's all the legal aspects, there's people aspects, there's emotional aspects, there's financial aspects. All of these are happening at the same time, culminating in some sort of an event. And that's why it becomes so intense. So prepare yourself for something like that. Those of you who have spouses, prepare your spouses if you're going into a process like that. It will be one of the most intense periods of your life. I wish you the best of luck. I hope it happens. I hope you get to experience it. But it is hard. It's not easy.
Thanks very much. So let's talk a little bit more about the process. We're definitely jumping around, but this is great stuff here. And we've gotten some questions already from the audience on the process. And so let's start with, the company, founder with the company gets a term sheet. And as a M&A attorney, we work quite a bit with companies as they get up to that stage and then through that process. So one of the things I would say is you're going to make sure that you've got a team of advisors, your board, your investors, your financial type advisors, and your attorneys to help you through the process. But maybe you guys want to talk a little bit about the process. When I have a company that a term sheet comes in, I say, this is great, this is just the beginning, right? What I want to do is get multiple term sheets and, quote unquote, run a process, right? I'll let you guys take it and I'll pick up anything else that's left.
Sure. I can share also another anecdote. So one of the companies we sold for a very good amount, hundreds of $1 million. Sometimes actually it happens in a very dramatic way. And the offer came in when, the CEO of Fortune 500 company calls up the founder and says that, I want you to be in front of your fax machine. And that was like actually, quite late in the night. And the fax comes in and it was an offer, a signed offer letter. So from that point, and of course, probably, it was building up in a sense that he was probably having some sense that, something might happen, but it happens that way. And then, of course, dates are put in and all that, and everything goes into high gear. And you're right, almost, I would say, sometimes board meeting can happen almost every hour. And it's like, everybody has to make them available and all that. I think the crux here also is that, from a founder's perspective, like, how do you manage your emotions at that time? And that is very, very significant because there are a lot of things going on. And other than the financial aspects also, I will say that, when a founder, truly an entrepreneur, builds a company, it's always a bittersweet moment. Like, when you are coming in and then you start thinking, and sometimes, you also feel, okay, what happens? Like, I go through it, I sell the company, what I do the next day. So there are a lot of things here that can go in. And I think, there, I would say, a good, thoughtful board can be very helpful. I think there is a duty for all board members to be like, to really be able to be a bouncing board and true kind of guide. I won't necessarily say guide because at the end of the day, the founder has to make the calls and they would, but a bouncing board for the founder. On the process side, so anecdotally, so that's how that dramatic. It started in that dramatic way, and then of course, we engaged, reaching out to bankers at that point. We haven't actually even talked to any bankers before, and then he selected one banker. We ran the process, and eventually, I think within next 2-3 months, it was done. but very, very intense from many different angles.
Let me pick up the thread from what happens after you sign a term sheet for an acquisition in a company. You've gone through the process, you've gone through some bankers, you've shaken hands, you've got a business partner who wants to acquire you now, and your wife is already buying a house, based on the money that's going to be in the bank pretty soon. At least that was my experience. What happens after that? So let me share the following piece of advice with you. This is the first thing which I now tell my CEOs on the moment at which that term sheet is signed. And I share with them the following statistics. On the previous panel, someone said that in their experience, 80% or more of term sheets that they signed for financing actually closed. The statistic I share with them is, in my experience, less than 40% of signed M&A term sheets actually close. In other words, the probability that this will close is not more than half. And so you really need to prepare yourself and the company and run in a very schizophrenic mode, which is extremely difficult for a CEO to do, given the lower probability that it will close. And most experiences till then have been that term sheets actually close. So that's the one piece of advice I would give. And I would generalize it to say that to keep a company running and to keep a business running, while you are also going through an M&A process, knowing that it may or may not happen is one of the hardest things that you will also do.
Let me just also add, Mike, that a nice decision for you to make will be to decide where you want the money wired. So again, you want to have set up ahead of time the understanding of how you're going to hold these assets, and there are lots of implications from a tax perspective and a planning perspective on that decision. And you obviously want to have the assets wired to a safe, secure, solid financial institution.
Yeah, and maybe just to pick up a little bit on that, you heard that board meetings every 3 hours, and you're probably thinking, well, couldn't they make a decision and get this thing together? In an M&A, so M&A is very different from venture. The diligence process, the entire process is completely different. There's much higher risk. There's usually more dollars at stake. It's a completely different structure, and it's really a different sort of set of incentives. And what you end up having is time being your enemy. Where there is time between when you sign that term sheet to getting through diligence, to getting the documents negotiated, to getting to completing the closing conditions, and to getting to closing, all of that is risk really on the company. And this is why you're having board meetings, and you're it's schizophrenia, and you are really pushing to get these pieces completed so that you can get the deal done, because the deal isn't done until it's done. And there's always the ability, into either in the term sheet or in the documents for the buyer to potentially walk away in certain events. And that's all risk really to the company. And so that's why at the end of the day, time is going to kill and speed is going to be what helps the process.
And if I can build on that comment, I completely agree. Time is going to be your enemy. There's a ton of details. There's a lot of moving parts. One of the most successful acquisition experiences that I went through with one of my portfolio companies was where the CEO was very experienced, very mature, and this is very hard to do emotionally because you want the deal signed. Obviously, by definition, this is going to be a huge event, and in their case, it was almost $500 million on the table. The CEO was mature enough to not actually sign the term sheet. They gave a verbal, they agreed in principle, they did lots of meetings, and they kept extending the term sheet to really, it practically was the definitive agreement. I mean, it was the longest term sheet I've ever seen in my life because the CEO had made sure that they had covered all the bets. So if you have that much maturity and judgment and experience and you have a board which can support you in that, it will serve you well. This is one case where a longer term sheet is better. More detail is better for you on the side of the seller, the company which is going through. And yes, most of the risk is yours. It is not the big company that is acquiring you as a startup.
Yeah, all that makes great sense. And I think that, you want to, in terms of details, ambiguity is also an enemy of yours. You're going to want to have that, things as clear as possible, because there are a lot of details and a lot of terms in an exit or sale of the company that are critically important to the company, the founders, and the stockholders as well. So maybe one thing I could maybe add in terms of some of the questions that we're getting here. Are there successful stories that you can say where this is, these are some of the elements that you would find in a successful, either getting to the point where it's attractive for an exit, and then, getting through the process. Definitely from my experience, I spent time working with companies, helping them get to the point where they are attractive for a potential exit, and then making sure that the process is such that it's being run to maximize value for the company and the stockholders. And that's you've got your partners and your customers who are great relationships, who may be the first potential term sheets that come in. Maybe you don't want to sign that term sheet right away. Maybe you want to make sure you get that confidentiality or the NDA agreement in place, so there's nothing untoward happening. And then maybe you don't sign that term sheet yet. Why? Because maybe it's not all the terms that you want. Maybe because it's got exclusivity in there. That means you can't shop around to others. Maybe you don't want that in there yet. You're negotiating that term sheet. You're running a process. You're getting your advisors to help along with. And we can say get your advisors, but it's actually very important to get your advisors, the people you trust, and the people who can really help. We can tell some stories, but I've got a story. I've got stories where we've had companies that got the term sheet, ran the process, but one of their board members wanted to sort of be in control of that process, and because of their agenda from their financial aspect, was not going to sell at a certain level of valuation, while everyone else at the company and all the other stockholders would have. That really torpedoed the deal, and it ended up getting done 2 years later at half the price. So it's important not only to get your advisors, make sure that they're the right ones and they're incentivized in the right way, and they're really looking at the interests of the company and all the stockholders as a whole, not just their one slice of their investment. But just want to open up to you guys.
From my perspective as an investor and a board member, I would say that the term sheet itself is the tail wagging the dog, which often happens in conversations like this. The term sheet is a representation of some business intent that someone has. In this case, an acquisition. They're trying to buy your company. And that business intent requires alignment. Michael just gave a very nice story of where there was a lack of alignment. And that is, of course, what is the most common reason why deals blow up. It's because different people want different things. That's not really a deal. A deal is a deal when both sides want it, or in the case of an acquisition, when all sides want it, because there are so many stakeholders that have to make it happen. So what I would urge you to think about is, why is this deal happening? What is the alignment? What is the underlying business reason that is creating this alignment, that is creating this opportunity? And then make sure that the term sheet represents it, the deals represent it, the process that you run represents it. If you're desperate, you're out of cash, well, that's a very different negotiating position than you're sitting back, you didn't really want to be acquired, and someone walked in and said, we'll buy you. I mean, we are all familiar with the story of Microsoft chasing Yahoo right here in Silicon Valley. How many times did Microsoft approach? How many times did that happen? And yet Yahoo is still an independent company over here today because they really didn't want to sell. So you have to have that alignment for a deal to close.
And the importance of alignment, again, post-exit is so incredibly important. And this gets to the point of business models amongst firms that will manage wealth for individuals. You want to be very familiar with conflicts of interest and avoid those. And again, find individuals who are aligned with your goals and objectives and your preferences, and also prevent you from being emotional about being connected to a position you have. You very much need that separation from the noise in the markets, okay? And you also, as an investor, need to be thinking about early the impact of inflation, the impact of spending costs, healthcare costs. Those can be quite critical, and taxes to what your assets look like over time.
Just a quick comment to add on. I think one thing it can help any entrepreneur a lot. If in all the financing rounds that's being done, at least there is some perspective of what all things would happen or what the lead investor might want to look for. And sometimes the objectives for the late stage investor and the early stage investors can be very different. So if at least, if when you are signing up and when you are doing financing, hopefully it's great if you yourself are experienced enough and mature enough to kind of think through, many of the implications. But if not, look forward to a board member of yours, who can actually offer that guidance? Because sometimes at that level itself, if it is taken care, all these misalignments can be handled a lot easier when that dramatic moment happens. And sometimes, you just don't have time to plan for.
And then for founders, individually or personally, what do you guys think of, founders at, liquidity? Founders selling shares maybe prior to the sale of the company or prior to the IPO. Is that something that you guys are seeing more of and folks are getting more comfortable with? And this goes to Leigh, some of your points about, really managing the founder's individual financial situation.
This is a recent trend in venture where we've seen founders get liquidity before the investors get liquidity in a venture-backed financing. This is primarily driven by two trends. One, the time to exit became much longer because of structural changes in the way we do IPOs here in the US. And the second was that because of that time to market, the valuations became very large while still a private company. And so there was this need for founder liquidity early on. In general, I'm not a fan of early founder liquidity. I think certainly for the venture-backed model, that does not create great alignment. You do see it, it's okay, I'm not religious about it. In some small cases, you may see some secondary sales, or perhaps it can take some pressure off in some situations. But it's a complex trend, and it has to be managed and thought through really carefully. And as a founder of a company, and probably CEOs, we saw a lot of hands, CEOs over here, I would urge you to think about that when you incorporate your company. Start thinking about how you will manage secondary sales, founder liquidity, and employee liquidity along the way. Some of you are familiar with what happened with Facebook, which stayed private for a very long period of time, and there was a ton of secondary sales which got created. That is a very complex situation. It has legal issues, financial issues, motivation issues, for your employees that you have to manage. So start thinking about that before you sign your very first check for the company.
Thanks, everyone.